Hey, this is Big G, or Gene, or Gino, or Dad, or however you know me. And this is going to be lesson 17. And we're going to talk about volume, moving averages, and indicators that you can find on charts. And hopefully you hung in with me on the last lesson. Lesson 16 was a long one, so this is going to be a little much shorter. And just want to introduce a few things to you and let you know a little bit more about when you're looking at charts, what you need to look at, or what you need to, or might want to be aware of. Some of these things you may or may not use, but just wanted to point them out to you. So this is just a candlestick chart of Tesla, and I think I told you in earlier videos that when it comes to volume and trading stocks, you want to trade stocks that are heavily traded. That typically, if I'm scanning for stocks, I'm going to look for something with at least a million trades a day. It trades a million shares a day. If you trade penny stocks, cheap stocks, stocks that aren't traded with heavy volume, sometimes it's hard to buy and sell. Sometimes the spread, the bid-ask, is wide. But if you're trading, Facebook, Tesla, Apple, Goldman Sachs, Boeing, the big names, they're heavily traded, and when you're buying and selling, there's going to be somebody on the other side that's going to immediately respond to your order. And the bid-ask spread, because it's heavily traded, typically the bid-ask spread is going to be pretty close, pretty tight as well. So that's one thing to consider, the total volume. And so in this case here, this is Tesla, and this is yesterday's chart, April the 9th, and this morning is April 10th. So yesterday, for example, Tesla traded 10.2 million shares were traded. And if you look down here at the volume, you can see that that was above average volume for the day. And the red means it was a bearish day. The gray volume means it was a bullish day. And of course, you see the volume here at the bottom of the chart. And volume, price and volume are really what creates all these indicators. Some of these indicators I'm going to show you here in a few minutes. It's really all about price and volume in so many ways. And a lot of traders just trade a naked candlestick chart like this, and they just look at volume and price, and they just go with the price action, and they gauge a lot of things based on volume. Honestly, I don't look at volume a whole lot on the bottom of the chart. I don't look at the daily volume much, other than knowing that it's a heavily traded stock. But a lot of traders, price and volume, that's all they look at. They don't have any other indicators on the chart. They might have a moving average line or something, but some trade just that simply. But just know that you want to trade a stock that with some heavy volume, and you can be sure that when you trade it, you're going to get an immediate response to your order. Now, what I want to do in this lesson is, in addition to just saying something about volume, is bring back some moving averages. And in earlier videos, I popped up the 920 moving averages, and we looked at, I think even in the very first video, we looked at the crossover idea of whenever the 9 EMA crosses the 20. The blue line is the 9 EMA, the 20 is the red. And again, this is the same chart, Tesla. I just added moving average lines to it. And so a lot of traders rely heavily on moving averages. I trade with the 9. I'll show you the chart that I typically look at. Or don't typically, I do look at. This is my default chart. And I got a lot of lines on it, and I'll talk about these green lines the next lesson, so just kind of ignore the green lines for now. But, and this is a 5-minute chart, so let me go to it daily. Excuse me. So on my chart, I have the 9 EMA, which is the blue line. I have ignored the green for now, that's next lesson. And I have the red, the 20 EMA. So I have the 9 and the 20 on my chart. And then the green lines are the Bollinger Bands, which again is lesson 18. But I typically have, just these two moving average lines along with the Bollinger Bands. And I'm watching how the price responds to the 9 and the 20. Now, some traders, let me go back to the just the candlestick chart. Most professional traders look at several different moving averages. They look at the 10. The default, as you see on stock charts here, is 50. So we're going to put the 10 on here. We're going to put 20. We're going to do the 50. We're going to do the 100. And then we're going to do a 200. And then I want to go to the S&P, the SPY, because it looks like it shows these things spread out a little bit better than Tesla. So here's a chart with the 10-day moving average, the 20-day moving average, the 50-day moving average, the 100-day moving average, and the 200-day moving average. Some traders use all 5 of these moving averages. Some use 2 or 3. Everybody's different. But some traders, you can see how, in this case, the SPY just kind of trails all the way up. The 10 and the 20, how close it stays to the 10 and the 20-day moving averages kind of goes all the way up. Some traders would hold that until it breaks the 10. Some would hold it until it breaks through the red line. Some would wait for maybe a crossover or something. But these are gauges, and especially in this case with the S&P, the SPY is a good indication of how the market's moving. Notice how just in recent days we got this big mess going on here. Just the market can't decide what to do. And notice last week how it bounced off the 200-day moving average. And for professional traders and people that I follow out there in traderland, this was a significant thing because it was flirting with the breaking through the 200-day moving average. And if the S&P does break through, then definitely would lead to a bearish market. So again, these moving average lines are just gauges. They're, as you can see how it follows the 10 in this case. It's just an easy way to gauge and trade and use as some direction in your trading. So moving averages are important. A lot of times you'll see price bounce off these moving average lines. Sometimes they just break right through it. This is Apple. I'm just looking, just kind of randomly pulling up charts. I don't have really a good plan to show you anything other than how these moving average lines work. You see how in the case of Facebook, it got near the 100-day moving average. It went through and bounced back through it here. And then Facebook has kind of crashed here lately with the whole news about the problems they're having with security and that kind of stuff. So moving averages are helpful. I definitely use them in my trading. As far as indicators, there are tons of indicators, and just to give you an idea, if you go down here on stock charts and hit the indicators thing, I mean, it's just tons of them, and just many, and you don't want to get overwhelmed with these. But they're just tons of different types of indicators, and really all of these indicators, or most of them, are based on price and volume. What I have on my chart, and to be honest with you, a few of these I don't even pay much attention to anymore. I might just kind of scan through and look at them. But I have the RSI at the top, and the RSI is a overbought, oversold indicator. You see down here, there's the 30, and there's the 70. And whenever the RSI is down at or below the 30 indicator, that's an indicator that the stock is oversold, which means that there's been a lot of selling going on, and it's likely that, not promising, but it's likely that that there'll be some buying happening soon after. And you can see in this case it did dip down here briefly in the case of Facebook, and pop up a little bit. And then when it gets near the 70, that's considered overbought. And whenever a stock is overbought, that means it's likely time for those that bought to start to sell and make a profit. And so you can see where as it gets up here near the 70, it dips down a little bit up here. It was up at the 70, and you can see it gap down pretty big here. Let's look at another one. Let's look at Goldman Sachs. And again, I'm just choosing these out of the air. I didn't really come in here with a plan to show you specific stocks, but just to show you the indicators. Goldman Sachs, a little overbought up here, dips down, flirting with overbought here, dips down up here, goes down. So a lot of traders will look at the RSI and get an indication of where the market might move next. And just because it dips down below 30 or above 70 doesn't mean anything. It could stay up there for a long, long time. In fact, I think, was it Tesla? I forgot. I just saw one minute ago that, yeah, here it is. Oh, the SPY. It stayed overbought for a long, long time, several weeks here, in fact. So it doesn't just kind of dip up and dip down necessarily. It could stay overbought for quite a while. So that's the RSI indicator, just what they call an overbought, oversold indicator. Down below here is a similar indicator. And let me go to, let's just go back to Facebook. You've got the CCI. People call a trader that I've learned from, they call these fins. And they use these fins as indicators as to when to buy and sell. Honestly, I have this on my chart, but I really don't pay too much attention to it. But again, it's kind of an overbought, oversold indicator as well. The PPO is similar as well. You've got the ADX down here. Some traders, their strategy is to use the ADX, and whenever the green line crosses over the red line, they buy because that's bullish. And if you can see on this chart, green passes over the red here. It's bullish. Green over red here, pops up. So the ADX is an indicator that some people will use to buy and sell, kind of like the moving average crossover method. Stochastics is another overbought, oversold indicator. This is the stochastics indicator. I look at it occasionally just to see, if it's down. It's similar to the RSI. If it's down near the 20, it means it's over sold. If it's up near the 80, it's overbought. So it's a similar indicator as well. And one other indicator I have on my chart that I do look at regularly is the ATR. ATR stands for average true range, and that is in this case it's $6.21, 21.5 cents. And average true range, this is the average that the stock moves in a day. So in other words, this is 621. Facebook will move an average of $6 a day. That means the range will be $6. It doesn't mean it moves up $6, down $6 a day. That just means the range will be a $6 range. So in this case of yesterday, let's cut the crosshairs on here. Yesterday, you see Facebook just formed a big doji, and the high yesterday was 160.53. The low was 156.04. So the range yesterday was about $4.50. So it's a little bit below the average true range yesterday. But that was the range for the day. The range is from the low of the day to the high of the day. So the average true range for Facebook is about $6.20. And average true range is over the last 14 days. That's what that 14 means right there. That's the average true range for the last 14 days. There are many, as I showed you, other indicators you can use. These are just some of the basic ones I use. Really, I rely on moving averages mostly, and candlesticks, support and resistance, some of the things I've already introduced you to. But some of these indicators can be helpful. But the big thing is don't go crazy with indicators. Actually, like I need to clean this up actually because I don't use most of these myself, at least anymore. So the simpler you can make it, the better. But I wanted to introduce you to these indicators and the moving average line. So I hope that helps a little bit, and we'll see you next time.